Year to date, the S&P 500 has performed very strongly, but today our focus is going to be on some of the lesser known names that Wall Street have been buying. Now, each one of these has at least a minimum triple buy across the rating summary, and the first one we are looking at is Genuine Parts Company. Now, this is down 21% over the last 12 months. Over the last 10 years, if you were a buyer, you would be up 52%, and we can see all-time highs. It does sit around that $186 mark from 2 years ago. It currently trades in the lower end of the 52-week range. When we look at the yield, nice to note, it is above 3%, and when we look at the forward PE, it does sit around 13.4. For a little bit of context, the S&P as a comparison does trade at around 23. And as we said, a triple buy rating. Now, when we take a look at this company in terms of dividend safety, it does sit at 80 safe, which is great to see. And their more recent increase this year, February, 5.3%, always a good sign. It is above that 4% minimum inflationary target that we always like to see on this channel. Now, when we look at the valuation of this company, as always, we do deep dives of companies on the channel. We run through every single one of these models. Today's episode, getting straight into it, our intrinsic value at $163, with the current price at $132. We start off with a margin of safety at 10%. We execute on this if it meets the 3 criteria. As always, a wide moat, strong financial metrics, and good forward-looking data. 10% will a buy at 147. At 15%, this would mean a buy at 139. And at 20%, we can see not that far off, around $1 shy. So you could argue for the first stock that Wall Street is buying today, a 20% margin of safety, and they themselves see some very large upside, 30% over the next 12 months. Their price target $171, higher than our intrinsic value. The next one they're buying is Keurig Dr Pepper, where as you can see, another triple buy rating. This one is trading in the mid to upper end of the 52-week range. It does have a forward yield a little bit lower than the first company, 2.63%, and we can see a forward P sitting at just above 17. Over the last 12 months, well, you would be up around 3%. Over the last 10 years, you would have outperformed the S&P. You would be up 244%. Bear in mind, this number doesn't include dividends reinvested, so you would be up marginally higher. We have another safe score. This does sit at 70, always nice to see, and a very nice high single-digit increase September last year at 7.5%. Now, when we talk about the valuation of this company, it does arrive at just over $36, with the current price at just under $33. A 10% MOS would be pretty much where it's sitting at right now, at around $32.59 mark. So if that is sufficient for you, then this would be a buy now. For those that are looking for a larger MOS, at 15%, a buy around 31. At 20%, you would have to wait for $29. But as we can see, 10% in the current market, with Wall Street indicating 14% upside. Their price target $37, marginally higher than the intrinsic value that we have calculated today. Now, tomorrow we will be releasing 49 Dividend Kings to all of those that are subscribed to the newsletter. You're going to get a lot of information, including the target price over the next 12 months, whether or not we see each one as undervalued and a buy now. For those that are subscribed to the free weekly newsletter, you'll also get access to all of these articles completely free, and you can read them straight away. The next one is coming tomorrow morning. So the next stock that Wall Street are buying, we have Emerson Electric, and look at that, a double strong buy rating from Quant, which is quite rare to see, and Wall Street with a buy from Seeking Alpha. It is trading in the upper end of the 52-week range, a forward yield just below 2%, and a forward P sitting just above 20. Over the last 12 months, well, up 22%, great to see. Over the last 10 years, up 63%, so you would have underperformed the S&P, and it is in fact trading not too far off its all-time highs. When we talk about this dividend, well, it does look to be safe at 78, but bear in mind it was a fairly poor increase last November at around 1%. Remember, we want to see here a minimum of 4. With the intrinsic value at $131, straight away we can see it is in line with around Wall Street, who do predict 20% upside over the next year. When we talk about margin of safety, well, at 10% it would be about up to 118. 15% you'd be looking around 111, and at 20% it isn't quite there yet, around $105. So you are getting at least a 15% margin of safety with with Wall Street indicating 20% upside. We then move on to another rare occasion with a strong buy from Quant and a double buy from the other analyst. It is Kimco Realty Corporation. This is a real estate investment trust trading in the mid to lower end of the 52-week range. A nice forward yield just below 5%, a P to FFO at 12.1, which is also lower than the sector P for real estate. Over the last 12 months, well, down 4%. Over the last 10 years, we can see this is down around 17%, something to consider. And when we take a look at dividend safety, well, a nice score of 70, it is safe. And that dividend increase in October, as we can see, pretty much in line with inflation. In terms of the valuation, we're around 22.81. Again, another one that we do see eye to eye with Wall Street. They see upside of 15%, 22.22 as the price target. With our margin of safety, we're at 10%, a buy at 20.53. At 15%, pretty much around that current trading price. So if like Wall Street and Quant, you are very bullish on this, right now you are getting a 15% margin of safety. This then takes us on to ET Energy Transfer, another double strong buy rating from Wall Street and Quant, a buy from Seeking Alpha, again trading at the upper end of the 52-week range. Forward yield just below 8%, so on the higher end. Forward P sitting at just above 11, and a very nice performance over the last 12 months, up 26%. Over the last 10 years, however, it is down around 44%. Now, when we consider the dividend safety for this company, it does sit at 50, borderline safe, and a very trivial increase to that dividend just over the last few months. As always, if any of these you do believe deserve a deeper dive, let us know and we can take a look. In terms of the valuation, well, we have an intrinsic value of $22.43, which should show us a nice level of MOS. 10% a buy around $20, 15% around $19, and we can see in today's episode it does have quite a large margin of safety, although this will depend on where you see this company over the longer term, sitting somewhere between that 25 to 30% level. In terms of Wall Street, well, not as high as our intrinsic value, but they do see 20% upside with a price target of just over $19. This then takes us on to another REIT, Alexandria Real Estate, with a strong buy from Wall Street and a double buy from the other two analysts, trading pretty much around the midpoint of the 52-week range, a forward yield of 4.5%, P to FFO again 12.31, lower than the sector P. Over the last 12 months, well, barely moved, 0.15% down, and over the last 10 years, up around 50%, but you would have underperformed the S&P, and we see some way away from its all-time highs, December 21 at $223. In terms of dividend safety, well, a good sign, it is safe at 76 score, and they did increase the dividend 5% over the last full year, which is always great, especially for those that do pay a higher yield. In terms of valuation, well, our value at $141, not dissimilar from Wall Street's 142, where they do see that 23% upside over the next year. Margin of safety, well, 10%, a buy at 127, at 15% around 120, and at 20%, not quite there in today's episode, sitting somewhere between the 15 to 20% level. As always though, let us know your thoughts about these stocks as we go along, whether you're adding to any of these or maybe they're on the watch list. This then takes us on to GD, General Dynamics Corporation, with a triple buy rating, a forward yield just above that 2% level, and a P that just sits above 19, 19.32 to be exact. Over the last 12 months, very strong, up 31%. Over the last 10 years, you probably would have marginally outperformed the S&P with this stock, plus 141%. When we take a look at that dividend safety, well, 97, the first one I believe that is a very safe score today. Always great to see. Nice high single digit increase this year at 7.6% as well. Then when we move on to the valuation, our intrinsic value at $312, as we can see, a margin of safety for this company at 10% would pretty much be around the current trading price. So if this is one that you do believe is a strong, high quality company, right now you are getting a 10%. For those looking at 15%, well, you'd have to wait for around $265. So at 10% right now, Wall Street do see some upside, 13%. Their price target is $319. And as always, let us know your thoughts in the comments below. Don't forget you can grab a copy of this model by clicking on that pinned comment below as well. And if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.